Everyone. Thank you for joining us on the webinar Retirement for German Nationals for those who worked in the US, German and US tax considerations in partnership with Rudel and Partner. My name is Thais Voot, and before we get started, I'd like to go over a few housekeeping items. This webinar will be recorded and shared with you afterwards upon request, so please send us a request to the events@GACC South email. I will also share that later, so don't worry about writing it down. And in addition, we will also share a copy of the presentation, so don't worry about scrambling for notes. We encourage you to ask questions, paste comments in the chat function. We hope to get to a few of these at the end of the webinar. Because we are covering a lot of information today, there is a chance that we won't get to all of them, but don't worry, we will put you in touch with our speakers after the webinar. And now I'd like to hand over the floor to Oliver.
Thank you, Thais, for the nice introduction. Also, myself and Julia, we would like to welcome all the participants to today's webinar. We have a lot of content to cover, but we're very glad to get the opportunity to talk about this. So today's topic is retirement for German nationals who work in the US, and we want to talk about German and US tax considerations. And maybe just introduce myself. My name is Oliver Hecking. I'm a partner of our Charlotte and Greenville office, and Julia, maybe you go ahead and introduce yourself as well.
Hi, everyone. So I am Julia Rojas, and I also work as a partner in the Charlotte office, and welcome to our webinar today.
Great. So then we're just going to go right away into the topics. Maybe just two words about us. I think most might be familiar with Rudel & Partner. We are a German-based accounting and auditing and legal firm. We have 49 offices in covering 49 countries with about 4,200 people worldwide. In the United States, we have now 8 offices. Our latest addition is our office in Detroit, which was opened last year during the pandemic. We have about 90 professionals who are German nationals, and many of them are licensed also in Germany and the US. So I think that's a little bit more unique to other firms. We provide services, typical services like assurance services, audit reviews, agreed upon procedures. We do have a fairly large business outsourcing, process outsourcing division in our firm. We obviously handle all the tax compliant matters as well as tax consulting, and we also have a transaction service team in Atlanta dealing with M&A type transactions. All right, let's go into the topics. As you can see here, there's a lot of topics we want to cover today, and up front, I just wanted to let you know we're only touching the surface. We want participants to make you aware of certain scenarios and certain topics which we think are most common in these scenarios, and hopefully that this is like a starting point for you to think about retirement and what you need to consider. We also included a couple of practical considerations, and so that with further ado, I want to go ahead and start. So basically today we want to focus on German nationals who are working in the United States right now and who are green card holders or dual citizens, because there are certain requirements you need to consider. And so if you're going to retire, the question becomes if you're going to retire in the United States, which means your primary residence will be the US, or whether you're going back to Germany and retire in Germany so that Germany is going to be your primary residence. So those are the 2 scenarios we will cover today. But we will also talk a little bit about German nationals who have been in the US, who are still in the US on a short-term basis for maybe 3, 4, 5 years as an expat. And they're going back to Germany, retire in Germany, but they may also have some implications because they may still have a home here in the United States, or they receive pension income. And the question becomes, how is that going to be taxed in Germany? So we will cover those questions as well. Okay, so the first question we have to answer is, what are the, when are you considered to be a resident for US and for German tax purposes? Because both countries treat it a little bit different. In the United States, if you are a US citizen or a US green card holder, then you consider to be a resident and you're going to be taxed on your worldwide income. Also, you're going to be taxed and considered to be a resident if you meet the substantial presence test. Julia, can you mute your phone? Your microphone, that would be helpful. So if you meet the substantial presence test, then you're going to be a resident as well. And that means you have to look at a 3-year test, which means you have to spend more than 30 days in the current year. So this would be, for example, if you spent more than 30 days in 2021, and then you have to count the 1/3 of the days of the previous year, which would be 2020, for example, and then 1/6 of the days of the year before the previous year, which would be in our case 2019. If you reach more than 183 days, then for US tax purposes, you're also considered to be a resident. And that means you're going to be filing a tax return in the United States and you're going to be taxed on your worldwide income. If you are a non-resident, then you're only going to be taxed on your US sourced income. And also you have to keep in mind, no matter where you live, if you're a resident or a citizen or green card holder, you have to admit your tax return by the due date, which is April 15th. Because of COVID, that has been extended this year to May 17th, but in general it's April 15th, and you can apply for an extension for 6 months, so the deadline will be October 15th. There is a special situation for US citizens and green card holders who live abroad. The IRS basically provides you an automatic 2 months extension. So technically your deadline is June 15th. You can also apply for an extension until October 15th. So now looking at the German side, once you're treated as a resident is a different, the definition is different. So in Germany, if an individual is domiciled or has an habitual abode in Germany, then they're going to be considered to be a resident. And also a domicile means that it is a home or dwelling owned by or rented to a taxpayer who has full control over that property. So basically, if you have a key to an apartment or to a home, you're basically considered being a resident in Germany. But it's important that domicile is a question of fact and it is not determined by the intention of the taxpayer. So we really have to look at the facts and circumstances to determine whether you're going to be considered a resident for German tax purposes. And the consequences are similar to the US. You're going to be taxed on your worldwide income, and non-residents are only going to be taxed on their German sourced income. And the filing deadline for tax returns in Germany is in general July 31st of the following year, but you can also ask for extensions where you would normally reach out or call the German tax authorities to ask for extensions. All right, then I pass it on to you, Julia.
Thank you, Oliver. So at this point, you might be thinking, the US tax system is a little bit severe. It taxes individuals on worldwide income, regardless of where they are or where they live. They still gonna have to be obligated to file income tax returns in the US. And potentially, if they have a tax obligation in another country, for example, in Germany in this case, they might be subjected to double taxation in some cases. But the good news is that the US tax code provides for relief in these cases. One of the reliefs of double taxation, it is on the US tax code. And is the fact that an individual who might be taxable in 2 countries for the same type of income will be able to claim the foreign tax credit on the US tax return. So how does that work? The foreign tax credit is claimed on the US tax return by filing a form. And of course, the person has to have foreign taxes that had paid or owe in the foreign country for the income that is being subjected to taxation in the US as well. So this foreign tax credit is claimed in the US tax return to the extent of the foreign source income that is being reported on the US tax return. So that's one of the mechanisms for avoiding or preventing or mitigating double taxation. Another aspect is claiming the foreign earned income exclusion. This is more applicable to U.S. citizens and green card holders who are working abroad. If they are performing services outside of the United States and they have established a tax home outside of the United States for a full calendar year, or in some cases for a 12-month consecutive period, then they will be able to claim the foreign earned income exclusion. What that means is that the portion of their income that it was earned outside of the United States, it will be excluded from U.S. taxation. Not 100% of it. It is limited to a certain amount, which every year is increased due to inflation. So this foreign earned income exclusion and also the foreign housing exclusion will also help prevent double taxation in this case. Now, when foreign tax credits and foreign earned income exclusions cannot completely mitigate double taxation, then we have the use of the treaties. The treaties, which are bilateral agreements between two countries that will help prevent situations in which a person, an individual, could be subject to double taxation on certain types of income. Of course, the treaties between countries will not cover 100% all income, but it takes in consideration most of the situations that an individual be confronted to in cases in which two countries are taxing the individual at the same time. On the German side, the foreign tax credits will be allowable on a progression, right, Oliver? Progressionsvorbehalt. It is called in Germany.
Correct.
In this
Yeah,
case,
Progressionsvorbehalt, correct.
Yeah. So Germany will exempt foreign income under this rule or this regulation, but also Germany has their limitations. In this case, foreign income taxes will be credited just if it is provided or applicable under the treaty, and also it will be to the extent of the German source income in this case.
Correct.
Moving along. Yes. Yes. So we also wanted to bring to your attention the importance of filing the foreign bank account, which is called generally or commonly by FBAR. It is important to highlight some aspects of this filing obligation that it is required for every person that is a U.S. resident. Whether you are living inside or outside of the United States, you are required to file these forms. Form FinCEN 1144 is the form that is used to report the foreign bank and financial accounts. All accounts that you have an interest in, or all accounts on which you have signature authority but no interest in or financial interest in, must be reported if the aggregate value is $10,000 or more. These forms are due every April 15 of the following year. Of course, there is an automatic extension up to October 15. So these are some of the highlights that I wanted to mention about the FBARs. It is necessary to file electronically. This cannot be filed on paper, and it can be done separately from the actual income tax return. One point that I wanted to mention on the FBARs that I noticed with some of our clients is that the filing requirement of the 10,000, sometimes it is not well understood. For example, if you're filing a joint tax return with your spouse and both of you separately do not have accounts that reach the 10,000 max. However, when you file joint returns, if we combine these accounts, they will be 10,000 or more. So some individuals think that because one of the spouses is not reaching the $10,000 mark, doesn't have a filing requirement because you don't have joint accounts, but that's not the case. If you're filing joint tax returns, even if you don't have joint accounts, the filing requirement will be 10,000 combined in the aggregate value. So I just wanted to make that point clear. In regards also to now talking about the Form 8938, this is another requirement that it is mandatory to file with the actual income tax returns. The Form 8938, it is about all assets, all financial assets and accounts that the person has outside of the United States, and the aggregate value, as noted on the slide there, for people who are unmarried, it has to be $50,000 at the end of the year, or $75,000 anytime during the year. This is for non-married individuals who live in the United States or are residents in the United States. If the aggregate for married filing joint individuals, the maximum is $100,000 at the end of the year, or $150,000 at any time in the year for married individuals. For people who are outside of the United States, of course, the threshold is a lot higher. For example, for unmarried individuals, the threshold is $200,000 at the end of the year, or $300,000 at any point during the year. And for married individuals, that threshold will increase to $400,000 at the end of the year, or $600,000 at any time during the year. So those are the max values for filing the Form 8938. All right, now we are going to discuss the expatriation tax under Section A77A. The expatriation tax, which is the regime that is imposed on individuals who have held their green card for a long time or for a long term. For example, individuals who were residents of the United States and have the green card for at least 8 years of the 15 years ending with the year of expatriation. These individuals will pretty much be subject to the expatriation tax regime. And what does that mean for those individuals? What that means is that the U.S. will consider that the person who is relinquishing their green card or citizenship in this case had sold or the assets that they possess will be deemed sold at the fair market value on the day on the last day that they remain residents of the United States. So covered individuals, in this case, covered expatriates, will include individuals who had an average annual tax liability of $172,000 for the past 5 years, right? That amount is indexed every year, of course, due to inflation. And covered expatriates also are individuals who have a net worth in excess of $2 million. So this is an important information that individuals who are contemplating renouncing or giving up their green card to keep those numbers into consideration, because the expatriation or tax exit regime could be a significant impact for them. Now,
Great.
passing on to Oliver.
Yes, thanks, Julie. So the next topic we want to address is if you receive income from Social Security and pensions, and so how is that going to be treated depending on where you live, whether you live in the US or in Germany. So in the general rule, and this is covered in Article 18 of the treaty, is that pensions and Social Security paid to a resident of a treaty country in consideration for past employment is taxable only in the country of the recipient's residence. And that's regardless of where the past employment occurred. So that means if you, as a German national residing in the United States for retirement, then that income is going to be taxable in the US. If you're going back to Germany and your residence is now in Germany, then that tax income, Germany has the right to tax that income. What does that mean? So that applies to lump sum payments as well as periodic income if you receive pension income every month. So from a US tax perspective, that would cover qualified retirement plans, which we will discuss in a minute as well, like the typical 401k, which we think most people participate in, then the simple retirement account, the simple IRA, and Social Security. Which is not covered by Article 18 are individual retirement accounts called IRAs, individual retirement annuities, and the Roth IRA, which we will also talk quickly about in the next slides. Those are all covered in Article 21, but the treatment is ultimately the same. So the country of residency has still the right to tax this income. So basically, where you're going to be located determines who is going to tax that income. On the German side, that's why I kept also the German wording as well, because sometimes the translation is going to be difficult, but Germany has different types of pension income. So Germany has pension funds, direct funds, Direktzusagen, the Social Security, and also pension funds for liberal professions like lawyers, accountants, doctors, and so on. All of that is covered by this treaty, by this Article 18 as well. Which is not included are, for instance, if you're receiving a direct insurance from Germany, or like a pension plan, which means Pensionskassen or Pensionsfonds. Those pension income will be covered by Article 21, but also it's only still taxable only in the country of the recipient's residency. So this is very important. The next question then is, how is the income going to be taxed? And those, we received a couple of questions before the presentation as well, and we hope that this is covered in this presentation as well. So the income, the taxation is basically as follows. If you, from a US tax perspective, the pensions and Social Security will be taxed at your ordinary income tax rates. And retirement distributions are includable in your income to the extent that the amount received exceeds a planned participant investment in the contract. So that means only the gain will be taxed in the United States. In Germany, Germany treats the taxation a little bit different, especially after the change of the law in 2005, where Germany is now changing the Social Security income to a deferred taxation. What does that mean? So that means basically every person or everything a person pays into the retirement is going to be tax-free, and the pension income will be taxed later on, which is kind of typical what we have, for instance, when you contribute to a 401k plan here in the United States. And this transition takes place gradually over a 35-year period. So it started in 2005, and this transition period will end in 2040. So what is that going to mean? For example, if you start your retirement now in 2020, your retirement income, let's say your German pension income, will be 80% subject to income tax. And after that, it increases by only 1% point at a time. So that means that the point when you retire in 2040 or later, then all of your income will be taxable in Germany as a pension. And the portion of your pension that is taxed is determined by the year in which you retire. So if you retire in 2020, that 80% taxable income, that percentage is determined at that point, and it's not going to change, even if your retirement income is going to increase by adjustments, for instance, made by the German government on a yearly basis. So that is also an important factor. And the income is going to be calculated according to the progressive tax rates in Germany. Then the next considerations is now what is when you receive a payment and you're residing either in the United States or in Germany. And we kind of split it. The left side is when your residency is in the US, and on the right side in green is when your residency is in Germany. So if you are a German national retiring in Germany, the payments you receive, for instance, from the German Social Security Office funds, they are fully taxable in the United States. So the partial taxation I just talked about is not applicable in the US. So you have to include that income on your US income tax return. Germany as a source country will only refrain from taxation if the former employee submits a certificate of residence from the US tax authority. So in Germany, normally if you receive a pension, the tax authorities assume that you're going to be a resident in Germany and will withhold taxes in some cases. In order to avoid that, you need to reach out to your German tax authority. And in this case, for people living abroad, that's the Finanzamt in Neubrandenburg. You have to basically inform them that you're not living in Germany and that your residency is in the United States in order to adjust that and to avoid any income tax withholdings as well. So that's something. We also include the address and information about the Finanzamt in our resource slide, which is at the end of the presentation. So the United States is a little bit different. So if you a German national and living in the US and residing in Germany, I'm sorry, then your payments from a US retirement plan, for instance, is subject to the German income tax laws. And that's very important. So Germany has the right to tax your income, whether it's a pension income in the US or your 401k retirement. And the key here is that it's going to be taxed, excuse me, under the German tax law. So you have to look at it from a German tax perspective and determine how that income, how that pension is treated under German tax code, and then how that is going to be taxed. Because there's various categories in Germany where that can fall under. So it's very critical that you have a German tax professional help you with the determination how that income is going to be taxed in Germany. The retirement income and social security incomes are usually exempt from state tax, and the 401k income is generally taxed as a regular income in Germany as well. One thing we want to mention here is the savings clause. So the United States, no matter where you live, basically has the right to tax you on your worldwide income and provides a tax credit, which Julia already said, to avoid double taxation. One other thing to point out is if you receive Social Security income and you're living in Germany and you receive US Social Security income, that Social Security income is not taxed in the US. So that will not be subject to income tax. That's one of the exclusions from a US tax perspective. We also want to provide you some practical considerations. So the first one is if you receive Social Security payments as a US resident and you live in Germany. So what do you need to consider? First of all, you need to make sure, are you eligible to receive Social Security benefits in the US? And for that, normally the general rule is you have to 10 years of covered work history in the United States, which equivalents to 40 credit points in order to be eligible to receive US Social Security. Another big point is that the US Social Security Administration will send the payments directly to your German bank account. But we want to remind you that it's probably going to be easier to keep your US bank account and have the US administration wire or send you the money to a US bank account, because there are fees involved, there's foreign currency risk. So all of these things are probably are things you need to consider when setting up your payment plan. Also, one very important point is talk to your bank or to your brokerage firm before you moving back to Germany to make sure that they're not closing or freezing your bank accounts. So we had this as well, that US banks are getting very afraid to work with green card holders or citizens abroad, and they sometimes close your bank account. So you want to make sure that your bank keeps servicing you while you're living abroad. And on the other side, keep in mind, because of the latest regulation like Patriot Act and FATCA and other laws and rules that made it very difficult for US citizens and green card holders to open bank accounts in Germany. And some of you probably already experienced that while living in the United States and the German bank was informed that you are a green card holder or you're a citizen, they may close the bank account because of that, because they don't want to fulfill the requirements to report you to the United States. So there's a lot of administrative burden involved, and a lot of German banks don't want to deal with that. So that's why you also want to make sure that you deal with banks in Germany who are capable of dealing with US citizens and green card holders. On the other side, practical considerations, if you living in Germany and you receive Social Security, one thing is that the US Internal Revenue Code and is requiring the Social Security Administration to make withholdings for non-resident aliens on your Social Security monthly benefits, which means if you don't do anything, normally the administration will withhold 30% flat tax from 85% of those benefits you receive on a monthly basis, unless you as a recipient qualify for the treaty benefit. And that means that you have to inform the administration or the withholding agent in the United States that you are now residing in Germany and that you're going to be exempt from the withholding tax. And in order to do that, you normally have to fill out the form W8BN and provide them the signed version in order to avoid any withholding tax. But in case taxes have been withheld, you can reclaim a refund by filing a 1040-NR, non-resident tax returns, to claim the refund on the federal level as well. All right, Julie, back to you.
Thank you. So now we are going to talk about one specific example of this individual. So this will bring some of the discussions that we have today together and help us understand how the laws apply. So John is a green card holder who has been living in the United States for the past 20 years. Before that, John was working in Germany, and he was contributing in Germany to the social security system for 15 years as well. So now John is contemplating to return to Germany when he turns 65, and he wants to keep his green card so he can be able to travel back home and visit his grandchildren. So now, what are the tax consequences in the US or in Germany of this situation? So first of all, John will continue to file his US tax returns normally, and he will have to include his Social Security income from US sources and German sources as well, because it is the understanding that he will also receive his German Social Security once he retired. However, now that John is residing in Germany, we know that there is an income tax treaty between the two countries, Germany and the United States. And there is a great potential that the US Social Security income will be exempt on the US tax returns, provided that Germany is going to tax that income. So that is pretty much the solution in John's case. To recap again, the income will be taxed in one country, and that will be Germany, where he resides. Now we are introducing the differences and the implications of having a 401k, having an IRA or a Roth IRA or a Roth 401k. The highlights here when it comes to taxation, it's important to understand the differences. And on a traditional 401k, contributions, as we all know, are made pre-tax, which means taxes are deferred for when the person decides to retire and take qualified distributions. So what are qualified distributions in this case? What is that? Well, when a person reaches certain age, in this case 59 and a half, the person is able to withdraw funds from their 401k account, penalty free in this case. Of course, taxes will be due because the taxes were just merely deferred. Now the taxes are due. So in which other circumstances are the person eligible to make qualified distributions? For example, if the person terminated employment, that's one opportunity also to withdraw penalty free. When the person suffers the hardship, when the person becomes disabled, or when the person dies, and then the beneficiaries will be able to benefit from this, from withdrawing from the 401k. Now, what happened on the other side with the Roth 401k? As we know, the contributions to the Roth 401k are made post-tax, which means that we already pay tax on that income. It's not going in pre-tax. So when you make qualified distributions on a Roth 401k and you reach age 59 and a half, then your withdrawals will be tax-free and penalty-free. Of course, there is a restriction here too. You have to have the account for at least 5 years, which means the first contribution must have done 5 years before, so for you to be eligible to take withdrawals from the account tax-free and penalty-free. And other circumstances in which the person can take qualified distributions is if the person becomes disabled or the person dies, passes away, and then their beneficiaries will take that account. Now, what happened then when we make early distributions in these accounts? Well, what happens in this case, or any of the two accounts, the 401k, traditional or the Roth, you will be penalized. You will have to pay a 10% penalty for taking distributions early out of the account. So this is some of the highlights that you need to keep in mind in regards to the 401k. Now, talking about the IRAs. Now, a traditional IRA, what does that mean? What it means is that you're making contributions. Contribution is a self savings plans, let's say, for retirement. It is not tied to any employer. You do it on your own. So in this case, the IRS or the U.S. tax code allow for a deduction of the contributions that you make to a traditional IRA, which means that this could be also pre-tax in the case of making qualified contributions. And that happens when the person doesn't have or is not covered by a retirement plan at work. They can do that. There are limitations, of course, involving the age of the person. And distributions in this case will be also require minimum distributions when the person turns age 72. This is new after year 2020. Now, for traditional IRAs, qualified distributions will happen also when the person reach age 59 and a half. Income taxes will be due, and federal income tax withholdings will be deducted as well. But there will be no penalty in this case because it is a qualified distribution. Now, on the other side, the Roth IRA, contributions are not deductible because they are made with post-tax dollars in this case. There is no age limit to contribute to a Roth IRA. And there is no required minimum distributions in these cases. Those are some of the highlights that differentiate both the traditional and the Roth. Qualified distributions are very similar for both. When the person reaches age 59 and a half, after 5 years of the first contribution, it will be tax-free and penalty-free. Or if the person becomes disabled, die, or the person wants to buy his first-time home or build a new home. In this case, those will be qualified distributions. But now what is important to highlight, how does this impact an individual who is considering or contemplating to retire in Germany? Well, the income that is received from any of these savings schemes are not qualified in Germany as pension. This will be regular income for the individuals who are residing in Germany. So distribution from these schemes will be taxable in Germany as well. However, as we all know, there are foreign tax credits that if a person it is subject to tax in two different countries for the same income, then the U.S. on the U.S. tax return will allow a credit, and in some cases, Germany, if the treaty provides for that, also allow a credit. Now, for individuals who become non-residents of the U.S., right, and they have any of these type of accounts that they have held for many years in the U.S. and now they are receiving distributions while they are outside of the United States and they are non-residents of the United States, then the case is different here. Then these individuals will be subjected to tax withholdings in the U.S. because the financial entity in the U.S. who manages those accounts will be required to withhold taxes from that. In some cases, they will be subjected to a 30% non-resident tax withholding under Section 1441. However, if the person provides proper documentation, one of them is the Form WABEN, in which the person provides a confirmation that it will be subject to tax in his home country, then in this case, it is a possibility that the person is not subjected to the tax withholdings. And if that's the case, maybe the person is not going to be required to file a U.S. income tax non-resident tax return. If that's not the case, then a non-resident person who is receiving distributions from any of these type of accounts will need to file a U.S. non-resident tax return to reclaim back the tax withholdings that had been taken out on the first place. So these are some of the highlights that are associated with owning any of these accounts, and it's important to remember how the taxation will happen in either case. Do you want to comment, Oliver?
Yeah, and I just wanted to mention one thing because that is important. So if we have a situation where you, as a German national now retiring in Germany, you will have these type of incomes. And then the question is, we determined now that Germany has the right to tax the income, and Germany will tax the income, whether it's from a US pension plan like US Social Security, whether it's from a 401k or Roth IRA, all these things going to be taxable in Germany. Now, it is very important, and I've stressed this one more time, the German tax code now determines how that income is going to be taxed, because there's various types of incomes and various tax codes in Germany you have to look at to determine what is this plan, because the 401k plan and IRA plan is not something Germany is familiar with. So it needs to be looked at and determine how is that going to be taxed, what portion of the income is going to be taxed, and how, and so that's very important, and that needs to be done by a German tax advisor to help you with that determination. Here also maybe just an example we just had recently about an individual who used to live in the United States, moved back to Germany, and he received a lump sum payment from the financial institution in the US for out of his 401k plan. It was $120,000, and then we had the situation where the financial institution made withholding payments of $20,000 for federal and $5,000 for New York State. And the question now is, okay, what am I going to do? How is that income going to be treated? So we already said that this income is going to be taxed in Germany because his place of residency is Germany. But the other question now is, can he get the money back in the US? And we looked at this. We looked at this his plan, the 401k plan. We made sure that he qualifies, that the plan qualifies as a pension payment under the treaty, and this was all okay. And then we determined that he had to file a 1040-NR tax return in order to assert that he's a treaty-based German resident, and he can claim the treaty relief and then he can claim the federal withholding tax refund. And he also had to file a separate state return in order to claim the refund on the state level. So there's a little bit of work to do. And first step is to assess the situation from a US and from a German tax perspective. And then there's, in some cases, compliance involved as well in order to ask and to receive the refund. Okay, then the next step is we want to talk about investment income. I'm looking at the time, we're running a little bit short, so we want to make this really quick and then just go over it and give you a quick overview. So investment income, which usually covers dividends, interest, and maybe if you sell stocks, that's all also covered in the various treaties in Article 10, 11, and Article 13. So the one thing to remember is if you're going to be taxed in the general treatment is that these type of incomes are taxed in the state where you reside. Meaning if you live in Germany now, then Germany is going to tax it. If you're residing in the United States, then the United States is going to tax it. And the taxation is different. The US has to determine whether it's the short-term or long-term gain, and then the tax rate is anywhere between 10 to 37% or 15 to 20%. On the German side, Germany now has a flat withholding tax called Abgeltungssteuer, so Germany will tax it in general at a 25% rate, but in some circumstances there is a special treatment which is called Teilankünfteverfahren, which is a different taxation. And also some income may be taxed on your progressive tax rate. So again, this has to be looked at to determine what type of income it is, to determine what how that income is going to be taxed in Germany. So it's not as straightforward as it is in the United States. One thing we wanted to mention here is if you're residing now in the US and receive income, it is advisable to communicate with the German financial institution and to let them know that you are non-resident in Germany and that your residency is outside of Germany in order to avoid any withholding tax on the German side. And this is, most banks, they will have certain forms they're going to provide you, or they will ask you to fill out the tax form W9 to basically assure and inform them that your residency is the United States. On the other side, if you now residing in Germany, we talked about the savings clause and that Germany has the right to tax the income out of these type of investments. And the limitation of withholding tax of 15% is not applicable for people who are US citizens or green card holders. It's only applicable for persons who are non-residents from a US tax perspective. So the US citizen receiving income from German sources and US, the US allows foreign tax credits, as we already mentioned. So that's very important. And the other thing which we already mentioned is make sure that you're also providing the US financial institutions the W8BN form in order to avoid any withholding if the treaty applies in your situation. Because it's always very time consuming and costly to file a tax return to claim refunds. One other topic we wanted to mention is rental income, because we received lately many requests where people said, okay, I live in the United States, but I have a place in Germany which I'm going to rent out, or I'm going to inherit something in Germany and I want to rent it out and I'll receive rental income. How is that rental income going to be treated? Depending on where your place of residency is. And the rental income is different than the other type of incomes we discussed, because the property is located in the country where the property is located has the right to tax it. So in the case you have property in Germany and you're receiving rental income in Germany, Germany has the right to tax the rental income. If you have rental income in the United States has the right to tax the rental income. And those things you need to keep in mind, and there's obviously filing requirements involved with that. Here we list the United States. The rental income is going to be taxed as ordinary income. If you sell property, then it's a question of whether it's short-term gains or long-term gains, and that depends really also on your personal situation and tax filing status. There are certain exemptions in the United States. If you sell your primary residence, then certain profits may be tax-free, and you have to look at certain rules on a state-by-state basis as well. In Germany, rental income is also taxed as ordinary income at progressive income tax rates. Gains from the sale of property is taxed as ordinary income at the progressive income tax rates, but there are also some exemptions which apply in Germany. So if you sell your personal residence and you lived in your personal home 2 years out of 5 years, then usually the sale of that property is going to be tax-free in Germany. Or if you sell a property which you own for more than 10 years, then that's in general also tax-free in Germany. But one note, that does not apply to if you sell a parcel of land. And also you need to keep in mind that we have the trade tax in Germany, and we have this trade tax ruling where if you're selling 3 properties within the 5-year period, and this includes all the properties you own worldwide, you may be subject to German trade tax. So it's called Drei Objekte theory. Very important to keep that in mind. So if you have real estate in Germany, you're selling it, you may be subject to property tax. Also, this is a topic you want a German tax advisor to look at it to determine do the exemptions apply and how is that going to be treated. Very important. Then for here some practical considerations. If you're residing in the United States and you receive rental income out of Germany, then you need to file a tax return in Germany and declare that with the German fiscal authorities. Same applies if you're selling a real estate and you have gains from the sale of real estate. You need to file a German income tax return and declare that. in case your property, the sale of your property is exempt, you still need to inform the tax authorities in Germany about this, because they are informed about this transaction and they're expecting either a tax return or a notification that this sale was not taxable to you. Also, you need to consider, if you're residing in the US, that this rental income is going to be included and has to be included on your US income tax returns, and you will receive tax credits for the income taxes you paid in Germany. On the German side, one point to remember, which is important if you're living in the United States, if you're a person residing in Germany and you receive income from rental properties in the United States, that income is taxed in the US, but you have to, that income is exempt in Germany, but you have to consider the progression. So that income will be considered in determining what your income tax rate is. So that, please keep that in mind as well. It's very important. Julie, I think in consideration of the time, I would probably skip the example and then maybe go on to estate tax and just give a quick overview about the estate tax rules on the US and German side.
Yes, thank you, Oliver. So yes, we're going to go to an overview of the estate and gift tax considerations and key takeaways to keep in mind when it comes to taxation in the United States. So estate taxes are assessed or imposed on when you transfer property at the time of passing away. The transfer of property to beneficiaries will create a tax obligation in the United States. The current tax, estate tax and gift tax rates are as high as 40%. So it's very quite substantial. However, there are exceptions, exclusions for that matter, of estate and gift taxes in the United States for U.S. citizens and permanent residents. For example, the lifetime exception is $11,700,000 for 2021. So those are the thresholds for estate and gift taxes when it comes to reporting that in the United States. For a person who is a non-resident alien of the United States, there is considerations to keep in mind as well. A person is not completely exempt or free in the US. For example, if the state or the property it is situated or located in the United States, the non-resident individual will be subjected to some taxes. There is an exemption of $60,000, which is quite low in this case, and the annual exemption amount for the spousal transfer is $155K. So those are key figures that we need to keep in mind when we're talking about estate and gift taxes. Now, the annual exclusion for gift taxes in this case is $15,000. That's $15,000 per individual. If you're married filing jointly, and then both spouses can give up to $30,000 without any tax consequences. Now, when the gift is above this amount annually, then a form needs to be completed and submitted to the IRS, and a form needs to be filed to report any gifts above of these thresholds. So it is important to consider that. Now, as I mentioned, for non-resident aliens, I mentioned it before, just restating that they are not completely out of the loop in cases when they receive gifts or transfer of properties from locations or situated in the United States. They will be subjected to tax as well.
Okay, and I know we're running out of time, but let me just quickly address the German side of it, which I just want to point out the highlights. There are exemptions in Germany as well. So it's German follows the universal succession, which means that the heirs inherit the deceased assets as well as the debt obligations. The tax imposed on German residents is important to consider. An individual who is not a resident in Germany is only going to be taxed on assets which are situated in Germany, and the tax ranges between 7% to 50%, and there's also exemption amounts depend on the status, degree of your relationship, anywhere between 10,000 euros and 500,000 euros. I think we received a lot of questions, which was kind of expected. And we won't be able to address all the questions right now. I want to maybe talk. You're going to get those presentations, and on the Medicare side and on the healthcare side, maybe one thing important. That's a topic where we cannot really provide any information, because that is something where you need to reach out to the health insurance providers in the US and in Germany, and probably to the Social Security Administration if you have specific questions about if you are eligible for healthcare and what do you need to do if you're going back to Germany. Can you go back to the system? Yes, in general you can, but that's really those type of questions you have to get in touch with the local authorities to kind of determine your specific case, and you have to have health insurance coverage when you go back to Germany. So that's a given, it's statutory. The question becomes, can you go back into the governmental system, the statutory healthcare system, or do you have to go back into the private system if you have been privately insured before you moved from Germany to the US? So those are kind of questions you need to consider, but you need to reach out to those authorities, and there's some resources at the end of the presentation as well. Q&A, I'm just gonna maybe start a couple of questions, which are probably some highlights. I saw some question about WOS plan, WOS IRAs. It's very important. Yes, the WOS plan is very advantageous if you a US green card holder or a US citizen and you're living in the United States, because the income you receive out of it is going to be tax-free. It's not advantageous anymore if you're going back to Germany, because that income is going to be taxed in Germany. So those are things you need to discuss with your financial advisor, if that really still makes sense to have a WOS plan in place if you're considering moving back to Germany, because Germany will treat that income differently. But also, in order to do that, you need to talk to your German tax advisor and determine exactly based on your plan how that WOS income is going to be taxed in Germany. But that's definitely something you want to point out, and it's important to understand what type of pensions you receive in the United States and how that pension is going to be taxed in Germany. I will say this because of the volume of questions we received, that we will try our best to follow up on those questions afterwards. And we also included our contact information at the end of the presentation, so feel free to reach out to us and with specific questions, because a lot of these questions are very specific questions which really depend on the specific situation each individual is in, and so it's going to be very difficult to provide you a general answer. So especially there were some questions on exit tax. That's really sometimes specific questions where we need to look at this on your specific facts and circumstances, whether the exit tax applies. Because the thresholds are so high, I mean, I think only the high net worth individuals have to, the exit tax is going to be, has to be considered. But we wanted to mention it because it is a subject, and there are certain filing requirements you have to do if you, for instance, moving back to Germany and you're thinking about giving up your green card. So those are things you need to discuss with your legal advisor and with your tax advisor to make sure that you do the proper filings, because you have to inform the US tax authorities about the fact, and you have to make sure that you're in line and in compliance with all the prior year's filings before you give up your green card, for instance. So those are questions which I think it's going to be very difficult to answer. In general, we have to really look at the specific facts and circumstances. Julia, I'm not sure if you have any, I'm going through the questions right now. What we will do is we go through all the questions. We will make sure that we address those. Where we have the information, we may send a quick email if those questions can be answered fairly simply. If not, then we kindly ask you to reach out to us so we can discuss those questions in person. Ty, back to you.
Great, and as Oliver said, we did have a lot of very specific questions, so unfortunately, given the time, we are not able to go over each specific question, but if you have any additional questions, please feel free to email them directly. We will also put you in touch after the webinar. So we will send a introduction email to continue the conversation. And again, thank you for joining us today on this webinar live. And we hope that we can answer your questions within the next few days. Thank you so much, everyone.
Yeah, we appreciate you taking the time. Thanks a lot and have a great day. Thank you. Bye-bye.
Thank you. Bye-bye.